Afternoon, everybody. Welcome aboard on this lovely day in Sydney today. Unfortunately, we're all inside listening to this, but we will do our best to try and give you something interesting to take away and answer some of the queries that are continuing to be raised as the things move around, particularly with JobKeeper and people starting to look forward now as it looks as though we're having some positive feedback and some movement and potential for things to unlock in the near future. So I'll take you through a couple of things initially, and then we'll get Nick Noonan to give you an update on what's happening in the HR and workers sort of area, and then a banking update with Betty, and the finish, because it's probably going to be the longest one because it's about how you get cash as well, is from Mariana on JobKeeper. All right, so we'll just make a start. So the major thing that people are starting to come to us for now are thinking about the next phase, and the next phase is how they move into a startup structure and what their business is going to look like in long-term social distancing coming out of the hibernation mode. Everybody's starting to get their head around JobKeeper and working through that quickly because they need to, and then looking at all the other aspects. So practical things are being raised like, how do we operate with this social distancing? How is that practically going to work? How are we going to manage it? What sort of costs are involved, and what needs to be planned now to be able to sort of move into that in, say, 4 to 6 weeks? There's also a cash flow structure in that, and what the cost structure is going to look like going forward, and then how that will impact in all of the other issues like your bank funding, your JobKeeper, and having capacity to be able to do it. Do you have enough employees to be able to do it? Do you have the right employees? So all of those things are coming forward now. Some of the people are looking at opportunities to go and steal some sites while people are sitting on their hands, and looking at new leases to be able to gain a competitive advantage. They're generally the ones who are well cashed up and are ready to do. They're also ready to move. They're also merger sort of coming through. There's a few people looking at consolidating downwards and upwards in their supply chain to try and build a stronger beast and create some leverage. They're also generally supported by one party who's willing to fund it. And then there's also bank facilities and other parties, like you've seen the private equity parties hovering around Virgin because they're looking for things to do. And there'll be more of those in the smaller end of the market that we are seeing, and also in specific areas, equipment and whatever else. The other thing that people are starting to turn their mind to is how they reset their business systems, and in other words, set up how they would really like to set up, rather than actually setting up or being restricted by the current structure that they have. So there's an opportunity to be able to look at some of those, while particularly in businesses in, say, hospitality and other businesses which are in long-term sort of hibernation mode, is to actually change those things. And then there's also retraining going across. So the poll question we have there is more about clarifying where are people thinking about, and will social distancing change the bottom line? Because obviously there is going to be a release of people back into the wild at some stage, but what sort of format that takes and how it is done, I mean, we're seeing how the schools are going back gradually, is difficult to ascertain, and whether that's going to really impact bottom line is probably going to play out practically, and everybody's trying to work it out in their heads now. So the other thing I thought that was interesting to go through today, because we've had a few queries about it as well, is Virgin and why it's not alone, and why there are likely to be more to come, but also to look at specifically why Virgin was the one to fall over and what issues it has been facing for an extended period. Tony, if you flick over. So Virgin's had a problem for a couple of years, probably closer to 5, where it's been largely struggling to compete with Qantas, and Qantas has obviously had that turnaround in that time and been able to leverage its position. I mean, Virgin is a second player, but it is in one of the strongest airline markets, particularly the Sydney to Melbourne route is probably the second or third in the world for number of for profitability and for number of trips. So it does have it can base its bedrock around having an overflow around that. The issues it's had is it hasn't been able to deliver at the same level that Qantas has, and it has struggled on its as a competitive force. And that's exactly the same as every other previous competitor Qantas has had for the last 100 years. There is obviously a corporate graveyard of all of the entities that have fallen over, Ansett being the highest profile. So it's had 2 or 3 years where it's had losses. Most of those losses are on paper around equipment, structuring and costs, and it's also had to borrow through the nose to be able to continue, to be able to afford new planes and update its structure. So when you get to a point where in a volume business with high debt, Tanya, go to the next one, that means it can't service the debt, and it has major contracts around planes, fuel and currency hedges that just create an unsustainable position. So you can understand why when they asked the government to come in to sort of fund a few of those things, the government was less willing to consider those. And the reality of the VA is it allows them to exit all the contracts which are based off a different model. Because this is a volume business, its business structure and cost structure is based around the turnover. Once the turnover is gone, the cost structure doesn't work, the business doesn't work. So they haven't obviously been able to negotiate through a commercial resolution to all of those things. So hence the voluntary administration is the only way to reset that structure. I suspect strongly shareholders are likely to be sacrificed unless they become part of the solution. Richard Branson's obviously offering up an island as part of his solution. I don't know what impact that's going to have and whether that would be of interest to one of the hedge funds who are probably a likely buyer, but he is trying something at least publicly. In terms of the outcomes, our understanding from talking to a few people is that there has been discussion a number of weeks. DD has been going for about 3 months. The issue I think that the administrators will have to deal with is that unions will, unless there is a short-term solution, the unions will have their say, and they may try and even replace these administrators and go to one of their preferred. And so there needs to be movement relatively quickly. And as you can see from what the administrator has been saying in the paper, talking about number of parties already interested and strong interest, they're trying to placate a lot of those issues and indicate to people that's where it's going. And if you look at why somebody would buy this, well, if you can buy something that is worth potentially $10, maybe not the $20 that it is valued at, but if you can buy it for $10 at $7 now because it's under pressure, recapitalise it, and then realise some of the assets that are not required, I suspect that their overseas fleet will be diminished and significantly cut. So you might be able to sell a few of those and realise some cash. And then for a hedge fund, they can go to a relisting and just access the capital markets to recapitalise it that way. So there is some exit planning for them for a short-term hold. And the other thing that is obvious for any airlines that actually have any cash or are supported is coming in to access the Sydney to Melbourne route to be able to go forward with that. So I think it'll be interesting to watch that from the sidelines over the next 3 to 4 weeks. There will be some swings and roundabouts. Somebody will look like a likely buyer at some stage and probably not proceed. There will be a lot of that happening in the background. And there are obviously investment banks with a lot of people sitting around who they need to deploy and see if they can get some deals done. And they'll be talking to every single person in the world to see if they can do some DD for them. So it's a moving feast a little bit, and it's an interesting outcome, but logical. The other thing I think, which might be an unintended consequence here, is that it might give Virgin going forward an ability to be able to reset structures on the basis of the new world compared to Qantas. So Qantas might be stuck with some older style structures which will be less cost effective than the new structures. So there's a few things there that will create an interesting market going forward. But hopefully we don't have another Ansett on our hands. We have something which can come out the other side. And the rules of restructuring is that if you get it done quickly, it's the best way to do it, because the longer it drags out, the more unlikely it is and the higher the cost. So that's me done. We'll move through into Nick, who's actually been in hearings today and can give us some really practical updates on how things are going and what disputes are arising already. between employers and employees in relation to stand down and how that's playing out. And I'll hand over to Nick.
Thanks, Todd. Yeah, I missed last week. I was in the Fair Work Commission, and today I almost missed it because I was in the Fair Work Commission again. But today is quite timely because I was in the Commission dealing with a dispute lodged by 3 employees who had been stood down under the Fair Work Act without pay, and they are now challenging the legality and validity of that stand down. And interestingly, the Commission is expediting the hearing. Usually you'd look at a couple of months before you're listed for hearing. The Commission's essentially listed it for hearing in about 2 weeks and made other orders requiring the parties to put on evidence very quickly. So I think this would be potentially one of the first decisions made about stand down insofar as it relates to COVID-19. So interesting time. So I might just talk briefly about some of the things that have been keeping me busy in the last few weeks dealing with employers and my clients as employers trying to make changes to their employment arrangements to deal with this pandemic. JobKeeper has significantly changed things under the Fair Work Act. And what it did do, quite surprisingly, was not only deal with the payment rules, which we all expected, you know, how this $1,500 would be facilitated and who was eligible and who wasn't, but it made a whole raft of additional changes to the Fair Work Act and created new powers for employers in relation to things like stand down. So I'll just deal briefly with, I guess, the world before JobKeeper, and that's relevant because that is the world before JobKeeper. It's also the world for employers who are not JobKeeper eligible. And I've already spoken to a lot of my clients who might just sit outside of JobKeeper eligibility, which means they're dealing with the existing laws. And the JobKeeper laws and rules about stand down only apply while JobKeeper is in operation. So they will be repealed automatically at the end of September. So dealing with stand down, firstly, there's a provision of the Fair Work Act which enables employers to stand down employees without pay where they cannot be usefully employed for a period, and that is because of a stoppage of work for a cause for which the employer is not reasonably responsible. So pre-COVID-19, I don't think I had ever had to deal with that provision of the Act, but all of a sudden it became the most popular provision of the Act for employers that were feeling the pain about COVID-19. It's quite confined. Clearly it applies to businesses who are prohibited from operating, and therefore there's no doubt that their work has stopped, or also in respect of employees who might, for example, be required to quarantine, and that means the rest of the staff can't usefully be employed. But outside of those very obvious examples, there is a lot of scope for dispute. And to use the matter that I'm involved in now as an example, clearly there's a dispute on, you know, the applicants are deciding that they didn't believe my client had a legal basis to stand down staff. And that's in a situation where the business was not prohibited from operating, but it was feeling significant depreciation in demand for its services and decided that certain staff didn't have work that they were able to do for a period. So there's a lot of grey in that provision, which means a lot of my clients have been looking at alternatives to stand down. So alternatives to taking, I guess, the punt that a commission might decide that your stand down was invalid. And if it is invalid, potentially you've got an order for back pay. So any alternatives are usually best employed through agreement. So what I'm getting at there is, you know, agreement between employer and employee on things like, instead of being stood down, which is a direction, it's a one-sided direction, it doesn't require agreement, but reaching agreement to, for example, take leave without pay or unpaid leave, which is, you know, in legal terms almost has the same effect, but because it is done by way of agreement with staff, it removes a lot of the risk associated with stand down. Other alternatives would be things like agreement with staff to take leave, annual and long service leave. agreement about reductions in remuneration or reductions in hours and days work. Now, each of those things carry with them some risks and I guess some issues and underlying legal protections that you would need to be conscious of. And just to give you one example, if you had award related staff that have underlying minimum wage entitlements, you couldn't reach an agreement with a staff member to reduce their remuneration such that it was below the underlying minimum award rate. Even though the employee might be prepared to agree to that, it's not lawful or enforceable. Redundancy is obviously something that's in play at the moment. It's usually, I guess, the leverage to reach agreement with employees about alternatives to redundancy. I think in some respects, JobKeeper has complicated things for those organisations that might have been looking at redundancies, because quite clearly the effect of JobKeeper or the intention of JobKeeper was to keep people in jobs. So if you are a JobKeeper eligible employer and you've got JobKeeper eligible employees, any redundancies that you make, I expect to be subject to some scrutiny, or I guess there's risk associated with it, on the basis that the obvious example or the obvious argument from an employee would be, why did you make me redundant when there are all these other alternatives, including to stand me down and not have to pay me and simply pass on the JobKeeper $1,500. So it's a bit early to see how that will play out, but I've already seen, I guess, some tension in relation to proposed redundancies for JobKeeper eligible staff. Just moving on to JobKeeper, and it's important just to make mention to some of the specific powers that have been given to employers for this discrete period. I won't deal necessarily with the payment regime. I think that's got enough airtime. But as far as the JobKeeper changes to the Fair Work Act, what it's done is it's introduced a temporary ability for employers to stand down employees, either partially or fully, in response to COVID-19. So my view is, the government realised that the existing provision 524 was probably a bit inadequate. And for the reasons why I'm suddenly caught in a dispute on behalf of my clients, they have basically watered down the provision and made it easier for JobKeeper eligible employers to stand down staff. There are important procedural requirements that need to be satisfied. So things like consultation, you're required to give a notice of intention before you stand down a staff member, and meant to give them 3 days notice unless that's shortened by agreement. And any direction needs to be in writing. So that is a stand down direction under JobKeeper. There are also new powers enabling directions to be given by employers to employees in relation to things like where they perform their work, what sort of duties they perform. So if, for example, you've got an employee that could be usefully employed doing something else which is outside of their job description, or maybe moves them into a different classification under their award, these directions are meant to completely supersede any other alternative provision that might live in, say, an employment contract or an award. As I said, you can't forget some of the procedural requirements. And in fact, there's a brand new, I guess, division that's been set up in the Fair Work Commission to deal with stand down disputes. And I do expect, and I've already seen some of these disputes, particularly where you've got employees who may have been stood down without pay. Now the employer realises that they are JobKeeper eligible. And instead of wanting to simply pass on $1,500 to one of their employees that isn't doing any work, you've got organisations that want their employees to start doing some work, either for the $1,500 or for more than that. And that's where I'm seeing some pushback on behalf of employees who might suddenly be saying, why am I being required to do work now? My friends in similar industries aren't being required to do that, or I've got a concern about my safety. So all of these are things that would need to be taken into account. And if you are, I guess the response to all of that is we can give you a stand down direction under the JobKeeper changes to the Fair Work Act. And that might be to work reduced hours compared to your new normal hours, but you need to satisfy those other obligations. And one of them is about safety. And I don't think it's it's so obvious almost that it goes without saying, but at the moment with COVID-19, safety is obviously at the front of everyone's mind, and you need to make it very clear to your staff that the duties that you are requiring them to perform are absolutely safe. I might just leave it at that.
So that poll's going through. The other question I have for you, Nick, is, so the reality is everybody needs to follow a similar process that they have done previously. It's just that you just need a couple of extra boxes and just make sure you're hitting the same timelines that you were under the new regime. It's similar but different.
Yeah,
is that right?
it is. It's similar but different. And I think, as I said, it almost is a recognition that the existing provisions of the Act were probably inadequate. And they're recognising that they don't want disputes about people being stood down during COVID-19 or in response to it. But they only apply, this is really important, they only apply to JobKeeper eligible employers and JobKeeper eligible employees. So it's not as simple as just being eligible. You need to be participating. You need to be receiving the $1,500 and paying at least the $1,500 before you're able to issue one of those directions to your staff.
Another interesting layer over the top on JobKeeper. Okay, we'll move on to the next phase, which is Betty talking about funding, just giving some feedback around how that's going with the banks through this process. Thanks, Betty.
Thanks, Todd. Yeah, thank you. Thank you, everybody. Today I'm going to talk more about what the banks are actually looking for when applying for the SME funding of up to $250,000 backed by the government. So obviously, if you're an existing business banking customer and you have a relationship manager, then you will benefit. The bank already knows about you and your business, but otherwise the banks will be asking detailed information about business, who you are, who your target market is, years of industry experience, any websites that might be applicable. So it really depends on the relationship that you have with your bank. The other questions that the banks are obviously going to ask for are financials, so 2018, 2019 financials and year-to dates as well. Forecast P&Ls are important, and obviously taking into account the COVID-19 impacts and detailing what those impacts are. So impacts on sales, on expenses, or on any debtors that might not be paying. And so other items that the banks are looking for are actions that your business are taking to recover that income, because the term of these unsecured loans are 3 years, 6 months of which are deferred interest, and then the remaining 2.5 years the banks are expecting you to amortise the debt to zero. So they need to see some sort of income recovery plan. In fact, they'll be asking business how long they do expect it will take for normal trading conditions to return once COVID-19 is over. And business will need to be able to share their strategies as to what they are doing for income to return to normal trading once COVID-19 is over. When it comes to the actual loan amount, the bank's actually looking at 3 to 4 months of operating costs. So it's really important as an applicant that you look at what your expenses will be over the next 3 to 4 months. And with that said, the banks are also taking personal guarantees when distributing these funds as part of the security. So they are unsecured, but they are taking personal guarantees. So with the residential side of it, so with regards to the residential customer relief packages, the banks will defer principal and interest repayments of up to 6 months. And it's actually quite a simple process to be able to do this. It's really just explaining to the bank how, as an applicant, you have been impacted by COVID-19. And once you sort of tell them that story in a paragraph or more, the banks will defer principal and interest repayments of up to 3 months, and then another 3 months if necessary. The banks are also encouraging applicants, if they are requiring deferral of interest but would like some cash flow, to look at their repayments at the moment, because a lot of people are actually making extra repayments. So Reducing repayments to the minimum amount is another strategy, because a lot of people make extra repayments. Accessing redraw. A lot of applicants don't know, a lot of home loan customers don't know that they've actually got a lot of redraw in their existing home loans. Excuse me. And accessing that is actually quite simple. The banks are also offering really sharp fixed rates. So, and these are usually in the low twos. So sometimes this is a discount of 1% on existing rates. So 1% on $1 million loan is $10,000 of interest savings. So the banks are really offering some super sharp rates when it comes to fixed rate residential debt. But yeah, that's all from me. Thank you, unless you have any questions.
Okay. Thanks, Betty. We'll come back to you. Just one in the interim while we're getting Maz organised. Nick, what happens if an employee wish to stand down, is on a temporary visa? Can you stand them down if cause exists, and will they have to leave the country even though the employment's still continuing?
Yeah, good question. The first problem, I think, is temporary visa holders are not eligible employees for the
JobKeeper
purpose of the JobKeeper scheme. So you'd have to first decide whether they were JobKeeper eligible. I'm no migration lawyer, but the eligibility criteria for eligible employees include only Australian residents or Australian tax residents, which is usually just permanent residents or permanent visa holders. The only exception to that is, I think, some 444 visas, don't quote me on that, which are New Zealanders. So that's potentially a problem. It's a problem insofar as they may not be JobKeeper eligible. So then you are reverting to your powers under the Fair Work Act, which is 524, which is satisfying the original criteria, which is that there is a stoppage of work for a cause for which you are not responsible, and the employees can't usefully be employed. So the answer is yes, you could stand them down. It just wouldn't be a JobKeeper stand down. It would be a Section 524 stand down. And there may be implications on whether they need to leave the country, but that would be dependent on their visa. But the effect of a stand down, and this is important, is that the employment continues. It doesn't constitute a termination. It's not a redundancy. And most visa requirements for people to leave the country would be triggered if they were terminated, not if they were stood down.
Rather than stood down. Okay.
Yep.
All right. We've got a couple of other ones we'll come back to once Mariana's been through her detailed thing, which is she's spending hours upon hours every day going through with a lot of our clients and a lot of other people talking about how this all works. So I'll hand over to Mariana. You're on.
That's a tricky one. The mute and unmute. Yeah, thanks, Todd. Look, there has been a lot on the JobKeeper, and I know I've spoken to some of you that are on the call now, and really probably more wanting to know what updates there have been. So I'll go through that. I think one thing to note is, and I like to just go through the numbers, not because I'm an accountant, but you can see the weight I think this has on employers more than anything else, and their responsibility to get this correct. So, with the JobKeeper, we've already talked about that it's 1,500 per fortnight. There's 13 fortnights, so that's 19,500. But, I'm talking one person for 6 months, not bad. But when we're talking 10 employees, that's 195,000. If we're talking, that we've got 300 or 400 employees, you're looking at a lot bigger figure. So you're looking at the millions. And so when you're looking at it that way, you can see why it's important to get this right. And the area, and not just, and I think, Nick, you make some very valid points there. I think people are probably going, oh, well, make that one redundant. No, we'll stand that one down. And haven't really had a good look at the legislation, because it's not easy to make someone redundant if they're outside of JobKeeper. If the organisation isn't going down effectively, it's always hard to make someone redundant. But I feel that maybe people have rushed this because of the situation, and that may come and bite them. And so what I just want to be clear about is I'm going to go through a little bit of the decline in projected GST turnover and why it's important to get that right, or at least have enough evidence, as Nick indicates to as well, is to support your claim. What we've talked about in the past is really paying the $1,500 per fortnight per employee. So on the simplest form, in the simplest way, you have paid the $3,000 minimum to an employee. Now take a practical example here. There's 2 fortnights and a couple of days in the month of April. So it could be that you've made 2 pays and you've paid, if you've stood someone down, $1,500 less tax, because you've got to take the tax out, and you've made those 2 payments over those fortnights. Now it may be that you pay someone monthly. So it could be that you just took an average for the month. So I think it's $3,250 or something like that. So you pay them that per month. That's fine. It doesn't really matter whether you do it on a weekly, monthly, daily. No, you wouldn't do that. But effectively, as long as by the end of April, you've paid the $3,000 gross or $3,000 and withheld the tax. So, because that's sometimes a little bit confusing. And if your pay run's already been and you haven't paid someone $1,500 and you're within these rules, you just have to have a top up. So do an extra pay run. Now, I was going to say self-employed, there's additional requirements. So for example, where you just have you're an owner operator, you don't pay yourself necessarily wages, you're getting a dividend. Or it could be that you're getting a dividend from the company and you have employees. That's what that's about. Some can be self-employed as in they trade in their own name. Some could be the fact is they trade through a company, they're the director and get the dividend. Some could trade through a trust and they get a trust distribution. So there's special rules for these ones here. If you're self-employed, fine, you get the $1,500 fortnight. You don't have to pay yourself to get it. That's a little bit different. Whereas if you're self-employed through a company, trust or partnership, then you can only nominate one director, one beneficiary and one partner to get the JobKeeper. I'll go through that in a bit more in a few minutes. Have to have eligible employees. Now, in its simplest form, you go to your single touch payroll, because I think everyone must be on this at the moment. You had to really, unless you're a very small organisation and owner operators, you might not have to be on it, but in most cases, you would have Xero, MyOb, any of those softwares, even other softwares, they would have single touch payroll available. So they would have had to be employed on 1 March 2020. Easy to identify because you've got your payroll. You've got to be an Australian resident, Australian citizen, and permanent resident, subclass 444. So it doesn't allow for certain visa holders, as we mentioned before. You've got to be over 16, so it can't be your kid that's 15 and you've employed him or her. Full-time, part-time, that's easy enough. And stood down, may not be getting paid, may be getting paid, or casuals. There's special rules for casual, and you have to go back and say, all right, at 1 March 2020, let me go back to 1 March 2019. Have I been providing them regular employment as a casual over that period? So you can think of a waitress that might have been with you in a restaurant scenario, might have been an individual contractor that might have been with you as an individual. You might have been paying them salary and wages, ad hoc basis, but pretty regular. So that's easy to identify. Now, some of these people you would have been paying $1,500 anyway, or more than $1,500 a fortnight, and you keep paying them what you normally pay them. Those that are under that will actually benefit because they'll get $1,500. Now, you'll get that back as an employer, but it's a bit of a cash flow issue for the first month of April. After that, because the money doesn't come in until May. The other thing is that you might have, it's an interesting scenario where you might have been nominated by another employer for the JobKeeper payment. You can only get it once. So that's why the employee nomination forms get sent out to employees. So, you know, as an employer, you've checked you're eligible as an employer. You're going to look to see, okay, yes, I've got all these employees. How do I know if they're not working somewhere else and they've nominated it? Well, there's a form that gets filled out by them and has to come back to us, or sorry, to the employer and the tax agent by the end of the April, basically saying, and in that form it fills it out. They say they meet this criteria. They're an Australian citizen, then not under 16, etc. So the onus is on the employee not to lie. but effectively they can only get it once. So if they're filling this form out for someone else, you wouldn't give it to them, basically. You can still keep paying them, but if they're doing something for you, no problem them getting another salary somewhere else. It's just that you won't get the JobKeeper to subsidise that income. Say you've passed eligibility, what next? Just big picture, you enroll for JobKeeper, it opened on Monday. It's a very easy form to fill out at the moment. It's interesting because it's so easy, but there's so much obligation and potential penalties if you get it wrong. You have to have your employee nomination notices sent out to employees and received back by the end of the month. We just found out from the ATO that effectively if your employees are on leave or away and they can't get that form back to you by the end of the month, it's okay. So long as you've got some email correspondence and you'll get the form later. It is self-assessment. It's a form that just stays with the employer. It doesn't go anywhere. Eligible business participant nomination notices. So as I mentioned before, they're self-employed. So a director of a company, a sole trader. Now, a sole trader doesn't actually need to complete that participation notice. Only a shareholder, a beneficiary, or a partner in partnership. The one that's going to receive the 15. Interestingly enough, the 1,500 is besides the sole trader, is paid into the entity itself. So it's up to the entity to choose whether to pay it to the individual. But if it does pay it, it'll pay it to that individual. Prepare and submit application forms. So as there will be a lot of forms coming through that. I can go to the next slide, please. So I think this is the interesting bit. This is the bit that a lot of people are struggling with is how do I project my decline in turnover? Now, the first thing I've got to say is if you are a not-for-profit, and it's a clearly not-for-profit that's registered with the ACNC, then you have to drop 15% or more, and that's it. So, and we'll go how you compare that in a minute. If your turnover is aggregated turnover is under $1 billion, then you'll have to have a drop of 30% or more before you start JobKeeper. And if you're basically a significant global entity, and that is that your aggregated turnover, so connected entities, it didn't say this initially, but when the rules came out, unfortunately, it's there, and that's why they used the billion. If you're over that, then you have to have a drop of 50% or more. So that's a substantial drop. But I think the thinking from the government is that, you have your parent there to support you. Whether that's true or not is another question. So coming back to the decline in turnover, so we've worked out which rate we fit into. Then we go into the basic test period. There's two tests, basic test period and alternative test period. Most of us will be in the basic. We can't choose to be in basic or alternative. We're in the basic test, and unless we can't use that test for the reasons I'll mention in a minute. So if we're in the basic, we've got choices here. It's not dependent on anything, it's a choice you make. So you could use a monthly period beginning in the 30th of March, or you could use a quarterly period beginning on the 1 April. And interestingly enough, when the legislation came out, is that you can actually use the month of March, which is probably quite beneficial, and maybe not. But for some businesses that it's quite straightforward, it's easy enough to use the March figures because you don't have to project anything. You will use actual figures. And I'll get into what figures we're talking about. And then if you don't meet March, then you go to April and say, okay, if I look at my projected turnover, so projected GST turnover, it's defined per the GST Act, and you compare that to the actual turnover for the comparative month in the prior period. So if you've had a drop of 30% or more, 15, 30% or 50, let's just stick to 30 for the moment. You've had a drop of 30% or more, then you're in. And so once you're in, you don't have to retest again. Okay, so even though there are monthly requirements you to report, you're just not testing. All you're doing is providing information to the ATO that's required as part of the JobKeeper. So hence why it's important to get it right the first time. So when we look at March, easy, so long as you get the recalculation right. And what I mean by that is You could use, you can use obviously your actual figures for the period, and you take out any input tax supplies, so any interest components from your revenue. And also you might have had some sale of assets, you would take that out as well, so capital assets. Or you might have had a restructure in that period again, and you might have been moving assets because of it, you would take that out. So there's little things like that, but in most cases it's going to be pretty straightforward. Now, a lot of people say they go to their BAS and they go to the G1 account and they take that as the sales. Now, just got to be careful there. G1 is not necessarily actual sales. It's what G1 says is taxable supplies, GST-free supplies, and input tax supplies, and includes GST. So you need to take the GST off, you need to take off the input tax, and you can use the other two figures, okay, excluding GST. So in some ways, and for some, it'll be simple. Now, where, and as I say, if you can't get March, then go for April. Now, April, we're already on the 22nd of April, so we've got some actuals already. You've got to project the rest for the end of the month. So it may be easy for you to project. Now, question mark, I've been talking to some businesses and it isn't that easy to project because this isn't really something we've had before. So it is a difficult one. But what does project mean? So before I just get into that, I just think the other thing to consider is, and I would do the calculations for different months. So I'd do March, I didn't mean it, I'd do April, maybe, and then I'd do the quarter. That's how I do it, because what you want to have is this record that you've actually looked at it, you understand where your figures are coming from and what you project. So what they're saying is the projected GST turnover, and there's an actual ruling on this, and I'm just reading from a little bit of the ruling. It's a value of supplies made or expected to be made within the turnover test period. So turnover test period would be, say, April, if we're using April, or if we're using April to June, that'd be our test period. And it also says, according to the ruling, it's an objective assessment is one that is reasonable, a reasonable person could be expected to arrive at it having regard to the facts and circumstances which apply to the enterprise. So, there's a lot of construction contracts out there. There's a lot of income that, we've budgeted for pre-COVID. That may have changed. So, what is a reasonable person would be expected to arrive at having that income. So, and the expressions likely to make, likely to be made means the balance of probabilities. It can be predicted that the supply is more than likely not to be made. So, these are the kind of things you're looking at when you're projecting, which, can be different to, very different to what you have in your GST, what you put in your GST BAS. So that's why I'm saying they're not necessarily the same thing. The Commissioner will accept assessment of these turnovers unless he has reason to believe that assessment was not reasonable. So you've got to convince them that it was reasonable. And look, you only have to do the test once. So it's important that when you're doing it and you feel that you've reached that percentage, especially if you're over the 1 billion and you've got a 50% or more, if you can show that in a particular month, document it. And as I was saying before, it includes taxable supplies, GST-free supplies, supplies between members of GST groups. So what that means is effectively, I'm a tax consolidated group. Now, for the purposes of working out the percentage drop, you work at aggregated, so you look at all the entities together globally. But when it looking at your decline in turnover specifically, it looks at the employer. So you look at each entity in its own right, the one that has the employees. Some businesses have a tax consolidated group, they have 5 entities and 3 of them are the employers. So each one would do its own test. As we've said, projected turnover versus actual for the corresponding period. And each one is doing their own test. If they have intercompany loans, intercompany charges, not loans, income, or they would include that as well. So they're like a standalone entity. If they're GST group, it works the same way. So it just disregards the group and it just says, look at the entity. Now, we've got a real issue with service entities because what a lot of bigger entities do is they have a service entity and then they have the 3 or 4 operating entities. And so the employees are all employed in one particular entity. Now, at the moment, it does look at every entity on standalone. That's the way the legislation works. Could the intercompany charge be reduced enough to get it there to 30% or more? Very unlikely, but something to look at. And there's definitely, something to support that. The other thing is we're just waiting on the ATO. So we've sent them a few questions, valid questions that, there's no answer to right now, and asked them to consider. And so we're waiting for a response. Now, interesting enough, we sent some questions out on Monday, and we're starting to receive replies now. So they're trying to reply within 24 hours. I think that one's probably not one that's so easy to answer. And I know that the ATO was bringing out more guidance on how to project the turnover, but hasn't done anything so far. So we haven't seen anything. So if I can go to the next slide, please. So my last slide here, I think it's call to action. How we've been helping our clients is basically they might do their own projections and we have a review of them. So I think it's very important there. Also, where the employees are eligible, if there's something unusual about them, even sometimes the casual ones. Where we've got sole traders, helping with the application, it's not complicated. But again, like, for example, my mum's a sole trader, I'll give you that one. So she's an interpreter, and she works in her own name. So it's quite simple. I even went and enrolled her, very simple. But unfortunately, the ATO form was incorrect and it required you to indicate how many employees you had. It wouldn't accept 0. So I said 1. Anyway, so, and they submitted it. Now you can't go back and adjust it at the moment, but actually what it says, because then I read something that says you actually have to say 0 if you're a sole trader. So what happens if you get the form wrong? So I have been told on good advice that really it's just an enrolment form. It's not necessarily perfect and there's going to be some anomalies like that. The important bit will be when you have to declare your employees on single touch payroll or something like single touch payroll. And that's when you'll identify who your real employees are. So just little quirks like that because it's also new. Assistance with calculating decline in projected turnover, as I mentioned, it's not simply what's reported in your BAS, G1. Completion and submissions of relevant forms. So what you need to really have done is enroll. You can enroll by 30th of April. They are open till later in May, but most people are going to enroll before then. The JobKeeper application form, they do mention there's an application form, but I just think that's the next process. So I'll leave that out at the moment. I haven't seen anything. Employee nomination notices, you're not required to lodge them, but you need to have them back and in the employer's hand by the 30th of April, although they're a little bit, you don't get it 30th of April as long as you have it. Then there's, if you're an eligible business participant nomination, that means if you're, as I mentioned before, a sole trader, or not necessarily a sole trader, but you're the director, you're a beneficiary, you carry on a business, you don't get salary and wage, you personally. You still might have employees and that you might have both happening at the same time. You might have the employee nomination and you might have the eligible business participant nomination. So you could have one is for you, one is for your staff. And then your projected monthly declaration forms. So every month you are going to two things. One is you're going to have to declare who your employees are on a fortnightly basis in the first fortnight of the month. So the ATO will want to know, if somebody resigns in this time of JobKeeper for leaves for whatever reason, you have to exclude them out of the JobKeeper. You can't keep getting it if they don't exist anymore. And you have to make sure your records are always up to date. And that will be part of the single touch payroll. Remember, if you get it wrong, there's payback. Not payback in the sense of payback, but yeah, you have to pay back the amount plus interest and plus penalties. And they might not look at that favorably. So I guess be as honest as you can be, knowing what you know at the time. Projected monthly declarations, what they're going to need 7 days after month end, so say 7th of May, for example, is they're going to need the figures that what were your actuals for April, and then they want to know your projected for May. Now, you've already passed, so you're okay, but this is not for retesting. It is simply for notifying the ATO of what the damage of COVID has been to the economy, supposedly. I mean, but you know, once they've got the data, they've got the data. So it's a great data collection. I don't know what they're going to do with it. I mean, obviously they can use that later to say, well, actually your projections were really out. You said you're going to drop by 80%, you really dropped by 10. What happened there? So that's really the questions. I mean, that's really what I was going to cover. If anybody has any questions, are we taking them at the end, or are we at the end?
I'll start getting into them now for you, Mariana. The other query I had from some of the stuff that you and I have been doing and working through together is because of the way this all fits together, you need to have these forecasts and whatever else, and you also need to have the same thing for the bank. It does seem to be easier if you have something which does all of your JobKeeper calculations and understanding of that, and then you feed it into the rest of your calculations. Is that something that you're getting your clients to do? Mariana?
So was that a question for me?
Yes, that was a question for you.
So say that again. Sorry, I was reading the questions. I was distracted.
Yeah. So is that something that you're getting your clients to do, is having a look, not only are they having a look at the JobKeeper eligibility in a specific sort of aspect and when that's coming through and impacting their cash flow, but having a look at the overall cash flow so that they understand the implications about how that fits together, because that can impact what you're doing with JobKeeper obviously as well.
Yeah, look, and the reality is if they're really going to have to do these cash flows on a monthly basis. So
and a consistent basis, so that
monthly and consistent, right?
Yeah.
I mean, you don't want to give rubbish to the ATO. And just because you've got it doesn't mean, you know, even though you're not retesting, remember they've got this information, and we don't really know what they say, what they're going to use it for, but you don't really know. So I think, you know, you really have to make sure that you're projecting correctly. So Todd, yeah, it's very important that ongoing these cash flows are right, you know, you know, taken seriously is more, I think. I know everyone does take it seriously, but...
And one of the approaches that I've discussed with a client this morning is to actually, if they're on the threshold and they do qualify, but then ultimately because they do better than what they do, which is fantastic, than what they expected to, is they have the money comes through, then they can park it and they can use it if they need to, or repay it if they do better than what they think. I mean, this is a monthly thing, so it will change over that period, and you can reassess. As long as you have got eligibility and you've gone through the process and you have the money, well, you can access it as you need to or return it.
Yeah, that's right. Look, we don't know what's going to happen if you projected incorrectly, you know, because it is based on a projection. So what if your actual to your projections is slightly out, so you're, say, 28.5% instead of 30, you're probably on a margin and a cuff. But, you know, significant is 10%. So if there is a 10%, I would question whether you've got it right. And, you know, whether, well, one is whether you know your market, but the other thing is, I don't mean that in that negative way, but it might be that just things weren't as bad as you thought.
Or you know, there's one or two things change between the end of the month and the start of the month, and it's just moving things around. Yeah.
Could be. I mean, say like a charity might get a bequest.
Yeah.
So, you know, that's not expected. They didn't, you know, no one told them they were going to get it, but they suddenly now they're not at 15%. Yeah. So that is very possible.
Thanks,
but
Mass.
I think it's...
Mass, you're bringing in tax and death at the same time.
Yeah, that's right, tax and death. A sure thing, eh?
So we'll just clear a few of these questions. We'll clear a few of these questions, and we'll see if there's some more. Giuseppe's asked for on JobKeeper payment. They're getting mixed information around whether it's supposed to be separate on the PAYG summary or on pay slips. I think that's one of those things that the ATO is sort of trying to get to and deal with, but it's a practical issue that they'll probably put some guidance out at some stage. Is that what you're hearing?
Yeah, I think it's too early to tell, Giuseppe. One thing I do know is that when you report on single touch payroll, you'll actually you'll actually be identifying it on there. There's little categories, and I don't understand it all myself because it's quite, in depth. But there's this really good, and we can send it out to you. Thing on single touch payroll, the ATO has brought out, so I'm not bullshitting. But effectively, they've sort of said that there's a category for JobKeeper top up. So where you're topping up JobKeeper, it's separated. So that could mean that only the top up itself might be shown. But it's a normal salary and wage. So if I'm within the 1,500 a fortnight, it probably would just show as my normal salary and it won't make any difference. Whereas if I'm being topped up for the JobKeeper, or I'm stood down and I'm getting the 1,500 as a JobKeeper, then it may show separately. It's not taxed separately though, it's taxed the same. So you take out the same amount of tax. Hope that helps.
Yeah, I think there'll be a quarterly and an annual reconciliation which will go through, right? And there'll be some sort of mechanism like the old school things that we all had to do back 5 years ago before automated payroll came through.
I just should mention that all the STP providers, so MyOb, Xero, everyone you have as your payroll provider is changing and upgrading their software for JobKeeper. So just so you're aware of that, there will be some functionality. So that will come and it'll show on your, it potentially will show on your summaries. And that's how they're going to do it. Now, if you're not on single touch payroll through a payroll provider, it'll be a manual exercise that the ATO has some automated forms that you can download, and it's not as hard as it sounds, but I think the first time you do it might be a little tricky. So hopefully you're on single touch payroll.
And that won't impact anything about people who are receiving more than the 750, right? The way I understand it works is that the government is reimbursing you the $1,500 effectively.
Correct.
So if you're paying more, you've still got to account for it and tax on the higher amount.
The way I look at it is that if you're stood down and not getting anything, what the employer is acting is a bit like a Centrelink. So you're just passing through the money to that person and withholding the tax, so you just, they're still with you. That's how I see it. And the same with the top up. Instead of them trying to get that from somewhere else, they're getting it through the JobKeeper. And if no one has gone down and you're getting JobKeeper, and they're all over the 1,500, well, then it's really just subsidising the employer for paying those salaries. That's how you should look at it.
Yeah. Next one, Steve. 100% of his sales are input taxed. So his pre-COVID turnover was zero. And then how do you have a 30% drop of zero? So does that mean, I assume he will need to be looking at the alternative methods then?
Well, yeah, there's nothing specific on that where your sales are input taxed. Probably be interesting to know a little bit more about that. But I sort of wonder with, say, mining companies that are pre-sales as well, they get income from capital raise, but there's nothing on that either. So, I'll be interested because these are the kind of questions we can pose to the ATO.
Yeah. And just sort of work through them on a practical basis. But there's obviously a logical sort of outcome there because there is a drop. It's just not the way they've defined what it is.
Yeah, but very clearly right now, you don't comply with the rules the way they stand.
Okay. All right. Do we have any other questions anybody would like to put forward? I know there's been a lot of detail to digest. It's very complicated, and we've been trying to work through it. And Mariana and I have been through it a bit, and Maz has been probably 12 hours a day for a week trying to digest it and work through individual circumstances. So I think there's a lot of time that we've invested trying to understand it, but every circumstance is different. And the same with Nick. I think everybody's looking at the same issues differently and trying to work their way through them.
Yeah, and there's a lot of gaps. There's still gaps because this legislation was drafted in a fairly hurried fashion, and there will continue to be gaps and questions and ambiguities, and that'll all be case dependent.
And we haven't even discussed how it'll all interact at some stage with the normal rules and the normal tax rules and the normal employment rules. So that'll all change.
Correct.
Yeah, but I think just keeping in mind though, there is all this other stuff and compliance that we have to do. But God, if we didn't have it, if we didn't get the JobKeeper,
Absolutely.
I think that that's what we've got to think about. And obviously those that aren't in it, how do we get them in there? So, you know, and that's requesting, you know, the casuals, for example, was a great one. As an example, pre-government, they're lobbying to have the casuals in there. And unless you were 12 months, they didn't go, they didn't bend on that one.
Yeah. And
the one danger, I might just mention the casuals, I guess there was a lot of lobbying to get more casuals in. I guess the one danger with casuals is that you need to satisfy two criteria. One is that you've been with your employer for more than 12 months, but also that you are regular and systematic. And the significance of being regular and systematic is that is
part-time permanent
phraseology that's been adopted from the Fair Work Act. There's this concept of a long-term casual, which requires regular and systematic employment. And those long-term casuals have additional entitlements to things like parental leave and unfair dismissal rights. So by hurriedly wanting to include your casuals, you might also give casuals some entitlements that they otherwise didn't have.
Maybe they should be salary and wages as well. So it could give you a disadvantage.
Well, it's just, I've just seen a lot of organisations trying to get their casuals included in their count, but not appreciating that they've suddenly deemed them to be regular and systematic, which has different consequences.
Right. Okay.
Yeah, there's a whole raft of unintended consequences that have to roll out here, and that's what everybody's got to try and manage by having a plan and understanding how it works. So when things move around, you can actually adjust. And I think it'll be very interesting that those people who are organised and are lucky, there will be some people who get a competitive advantage coming out the other side. All right, unless we have any more questions, we're getting some positive feedback from a few people, and unless we have anything else, we'll move on and we'll reconvene for next week. But anybody who would like to submit any queries in the interim, we will send you back a response or add them to the list of for next week. All right, thank you to my fellow panelists, and we'll best to all and be safe, please. We'll see you shortly.